Hey, bulls and bears. Back with another dose of economic reality, back with another update, more financial news, your money, my money, our money. And I'm coming at you today from my studio, aka garage, which is cold. So, yes, I'm bundled up. Yes, I'm in San Diego, but it's been in the 50s and 60s here, 50s at night, sometimes in the 40s, even the 30s. But let's get into it. It's February 5th, 2023. And yes, it has went parabolic. What is it? It is the interest that we pay in the United States on the national debt. And I think all of us probably know by now we don't create our own money here in the U.S. We borrow the money. That's why we have this thing called the national debt. If we didn't have to borrow the money, there wouldn't be any such thing as debt. We could just print it ourselves. So yes, we're borrowing money from the banks that create it, and I think a lot of us know that when something goes parabolic, meaning straight up and down nearly, it's only a matter of time before the inevitable correction hits, right? When we see home prices go up, parabolic correction. When we see stock prices go up, parabolic. Certain stocks can go parabolic, and then usually there's a big correction that follows that. But we looked at several different prices of home charts here that over the past few years went nearly parabolic. I mean, the price increases over the past few years was crazy. And then finally, mortgage rates went up or were allowed to go up. And now we're starting to see a bit of a correction now in home prices. Well, let's take a look at this chart, the national debt. Tell me if you think this looks nearly parabolic, straight up and down. And here we are. We're looking at a chart here out of the Fed. This is the federal government current expenditures, interest payments on expenditures, aka the debt. And we look to the far right here. Ever since interest rates were pumped up there or increased, we see a nearly straight up and down parabolic increase in interest paid on this national debt. And this chart goes all the way back to looks like the 60s, and we've never seen this happen. Yes, it's been a steady increase. Sometimes there was a drop after the financial crisis and different periods where we actually saw a drop. So, example, right here after the financial crisis, they dropped interest rates down. Then we saw the debt drop, or the interest paid on the debt rather drop. That's always been increasing. But to the far right, yes, how much longer can this last at this level of increase? Right? Some people say what goes up must come down, and other people say no, this can keep going forever. There's nothing to worry about. All these people saying that some bad things on the horizon are, in view. Some people say all those people are just crazy cuckoos. I'll let you, the audience, decide what you think this means. Is this a bad sign when we see something go straight up and down like this? Can it keep going almost straight up forever? Or is something big and bad waiting on the horizon because of this? All right, so that's just one aspect of rising interest rates. We have the national debt, and the interest we have to pay on the national debt also is now going to be at a higher interest rate. And bring it all the way down from that national level down to the household level. Us here as consumers, I don't like to refer to myself as a consumer, but that's what we are. I mean, most of us consume things. Some of us produce things. Some of us produce just services where you're maybe talking on the phone to somebody, maybe you're shuffling papers, maybe you're typing on a keyboard. And some of us also produce real goods and items. Examples: farmers grow food. So yes, we are producers, but we're also all of us are consumers. We all consume. All right, now as individuals here, as consumers, as people that have our own personal finance and budgets to think about, higher interest rates can be good and it can be bad. If you have money to invest, or if you have money just sitting around, you're going to get maybe a little bit of a higher rate on your money. If you put it in a checking savings account or even a CD, you get 4% at some of these online banks now. And that may not seem like a lot. It's really not a lot. 4%. It's not even keeping up with inflation. But if you look at it compared to the last few years, you were lucky to get a fraction of a percent or even 1% when rates were at rock bottom. One of the difficult parts, though, is going to be able to have cash to invest, or to have cash to even put in an account to earn interest when everything costs so much more than it used to cost, right? So the high cost of living is definitely something that a lot of people are fighting through right now. Right, now let's change directions a little bit here. Let's talk again about the jobs numbers. Just a few, maybe 2 or 3 reports ago, we came out with a complete breakdown on what the jobs numbers really mean. Now, the funny part of this is that the Fed is going to be looking at these jobs numbers, and they're going to use this as evidence that the economy is doing wonderful, the economy is growing. In the meantime, a lot of this growth is based on just people getting further into debt, record levels of debt every quarter now. It increases to new records. But the Fed's looking at this and they're saying, wow, the economy's strong. Look at all these jobs added. We're going to go ahead and keep rates high and raise them even higher because everything's fine, right? The jobs added. But you look at the jobs added numbers and it has a lot of flaws in it, right? It's counting multiple jobs that people have to take as jobs added. So if somebody's working 2 part-time jobs, that's looked at as jobs added, even though they may have gotten laid off from a full-time job. So now they're working 2 part-time jobs, right? So that's jobs added in that sense of it. Also, a lot of the jobs are service sector, leisure, hospitality industry, typically not very high paying jobs. And that's why we see most households continue to go deeper in debt every month because the jobs don't pay enough to keep up with the rising cost of living. One part of that is the pay is too low. The other part of it is a lot of people just don't care. They're just going to go ahead and spend into oblivion because they know they have the rescue package called bankruptcy at the end of the day. Most people don't care if they file bankruptcy. They figure they create the money out of nothing. So why should we care if they erase it in a bankruptcy? Right? Essentially, that's what bankruptcy is. You're erasing the debt. So a lot of people just don't care. They're going to spend, have fun, live a nice life, take vacations, go to sporting events, go to amusement parks, drink 2 to 3 Starbucks a day, run up a bunch of debt, and have a good time doing it, and then just file bankruptcy. The delete button gets hit on the debt. I can understand that point of view. And there's been times on this channel where I've been critical of people spending money, running up debt. But on the other hand, you have to look at the point of view that a lot of people have. A lot of people say, hey, they print this money, they create this money out of thin air. So I'm not going to feel bad about running up debt, shopping, whatever you want to do, traveling, vacations, amusement parks, ball games. And I'm not going to feel bad about filing bankruptcy because they created out of nothing. Now they can hit the delete button and there's bankruptcy. You're basically hitting the delete button and the debt magically goes away. Certain types of debt, not so much. Student loans, most people still can't discharge student loans in bankruptcy. But why am I talking about this? Well, the jobs numbers, typically not paying very well. Also, the jobs numbers are jobs added, which does not subtract all the people losing their jobs, all the thousands of layoffs that we see, tens of thousands of layoffs. If you look at January, just in the tech sector alone was over 100,000 jobs lost. And we showed the chart here. But let's take a look at what another pretty well-known investor, I guess economist would be a right word also, has said, which kind of underpins what we say here on this channel. And this is going to be Peter Schiff. And here's how he put it. Since March 2022, there's been a decline in the number of workers with full-time jobs. In contrast, the number of workers with part-time jobs soared by almost 1.5 million. This is a weak labor market. All the new jobs are part-time and went mainly to people who already had jobs. Now, I wouldn't say all new jobs are part-time. I see what he's saying. But a huge amount of the jobs that are counted in the jobs added number are part-time. And this could be somebody already having a full-time job, having to work a second job. This could be somebody that got laid off from their job and now they have to go take 1 or 2 part-time jobs to try to make ends meet, to make up for the fact that they lost their full-time job. Yeah, so it's all kinds of craziness, all kinds of cherry picking the data to make things look like they're doing good. And I get emails from people, I get messages from people, very mad at me, thinking that I'm giving some sort of misinformation because all they did was they look at the jobs number and they look at the headline on some of my videos, thinking that I'm just not noticing the jobs number. Of course, we notice the jobs number. Now you have to watch my videos before you understand why the jobs numbers that are presented out there are basically phony. Right? For all the reasons that we pointed out here, time and time again. Also, what Peter Schiff just pointed out in one of his messages over at one of his social media sites. All right, since we're on the topic here of social media, let's get into a little meme time here. And this is a cartoon, a drawing. Inflation must be kicking in again. This dollar says best if spent before December 31st, 2005. Of course, that's an old cartoon. It says 2005 on it, but it's pretty relevant today. People are still wondering if they're best holding cash or if they're best just spending it now because everything they want to buy is going to cost more expensive down the road. Well, I've tried to take both sides, have some cash in case we do see deflation, but also invest something because if you see continued rising prices, then you may do yourself well if you are investing. Now, I'm not saying that's going to be the stock market or whatever it is. It could be lots of different things. I think right now is a good time to buy certain assets that are beat down, but other assets are going to become more cheaper. Housing, we're still going to see further corrections in the housing market. Now, going back to about a year ago now, when the Fed first started raising interest rates, I had doubted that they were going to keep rates elevated. And I am actually happy that they've kept rates elevated and that they're talking of keeping rates elevated and going even higher. I did have my doubts. In fact, I even talked about what would happen if the Fed would drop rates. Then we would see home prices shoot back up again. I think now the debt, though, is at such an enormous level. I'm talking about household debt, that it's going to be very difficult to revive the housing market with lower interest rates. And that's because just the debt levels right now, so many people are priced out of the market. Home prices haven't come down fast enough to reintroduce affordability into most households. Also, when you look at move up buyers, it used to be a lot of people would sell their home, have a bunch of equity to then put a down payment on a maybe a bigger house or a nicer house or more expensive house. Now that down payment from selling a home is not so big. It's actually shrinking because equity is declining. Right now, speaking of rising prices and inflation, I've got some news for everybody. You might want to sit down for this because this is can be pretty upsetting to some people. Are you ready? Nestle, yeah, Nestle chocolate. Nestle to hike food prices further in 2023. The CEO says that. And I can't think of the last time I had a Nestle chocolate. I think Nestle makes a lot of those Easter chocolates. I think I used to maybe have some of those a few years ago. I'm trying to cut sugar out of my diet, so to me, this news doesn't faze me at all. Sometimes I will eat chocolate though. Chocolate. I try to eat the dark chocolate, the stuff that's not really that sweet. And I even read some studies say there's some health benefits to eating dark chocolate. So for those of you that still eat Nestle foods, they make a lot of different things, not just chocolate, but Nestle in general is going to be hiking their prices. So if the Fed was right, if inflation was actually coming down, why is Nestle talking about hiking prices? Obviously, they're still seeing higher production costs and the cost of raw materials, probably the cost of delivering those materials. I still think we're going to see a huge surge in gas prices coming up again this summer. Now, people kind of felt a little bit of a sense of relief over the past few months here, the winter months, because of gas prices coming down some. But if you look back over about 5 years, even the lower prices that we saw in the winter months here have been just seasonal when compared to previous years. And in fact, if you look back over 5 years, the gas prices this past winter are higher than they were over the previous 5 years. So just because prices came down seasonally, in the winter months compared to last summer, I think it's giving some people, maybe even a lot of people, a false sense of security that prices are going to stay down. I don't think they're going to stay down. I think we're going to see new all-time highs coming up this year. Now, I could be wrong. There could be a huge drop off in demand with another, who knows, maybe another global shutdown like we saw in 2020 when we saw the price of oil go negative. Does everybody remember that? Negative price of oil? That just shows you how the prices can really be manipulated on, on the paper markets, on the digital readouts of these prices. When oil was negative $40, could you have went to the gas station and gotten gas for free because oil was negative? No, of course not. So that's why you have to decipher the difference between the paper price and the actual real physical, real world price, the commodity price. So in my opinion, prepare for more rising prices. Get your household budget in order, and get your preparations stacked up. Get stacked up on what you think is going to be valuable. I still think silver is going to be a huge upside potential. There is upside potential, but I still think we're going to see the ratio really get back to more norms. Now, the gold to silver ratio, I believe it's about 80 to 1. Let's go ahead and check in on that real quick here. And what do we see here? This is out of long-term trends here. Yeah, we're about at 80 to 1 right now if we look to the right here of the screen. It has been very low. Let's go back here to 2011. It was 40 to 1. But way back here to the 80s, wow, why does the chart keep glitching here? We were about 22 to 1. And even at some points, about 16, 17 to 1. So if the price of silver explodes to be back to where we had seen it back there in the 70s and the 80s, even if it gets back to 40 to 1, gold to silver ratio, basically you see a lot of upside here to silver. All right, so if my estimates are correct, even if we get back to 40 to 1 gold to silver ratio, then we're going to see about roughly $50 silver. And then if it gets back down to that 20 to 1 mark, you're talking about $100 per ounce silver, folks. So I think that's going to happen again. And the question in my mind is not if, but when. Alrighty? Alrighty, folks, keep stacking. Thanks for watching this report. What do you think about the parabolic national debt? Does this mean long-term doom? Or is it just going to keep going up into the stratosphere forever without anything to worry about? Please let me know. Talk to everybody very soon. Thanks for being here. Big love. Keep stacking. Bye for now, and peace.